Hi, welcome to Beginning Engineers. Today I'm going to be talking about finance and engineering, why finance skills and engineering matter. So if you're a subscriber of mine, or you're just watching this video and notice it's by someone called Beginning Engineers, you're probably saying, finance? I'm an engineer, not a finance bro. Well, believe it or not, finance is an important thing for engineers to know a bit about, and here are some reasons why. Understanding the financial value of projects, calculating break-even points, helping to convince management to make decisions, helping the business you work at stay competitive, determining the value of the worker, determining the value of the machine, and just in general, being a more well-rounded engineer, which is critical in today's world. The point of this video was to not have you become a finance expert. I don't have anywhere close to the skill level needed to do that. But we can go over some of the basic financial formulas and concepts. The first being the net present value formula. So one of the core tenets of finance is that time and money have a strong relationship. A dollar today is better than a dollar tomorrow. Time is money. I'm sure you've heard that before. And the net present value formula helps capture this core financial idea. It's one of the core financial equations. So I have it on the right side of this slide. The net present value of an investment or a project is equal to the sum of the required rate of return, so this will be your net cash flow coming in, divided by 1 plus your discount rate, which is the interest that could be earned with a similarly risked investment, raised to the power of t, which is the number of time periods, then you subtract out all initial investments. Now, I remember that a lot of this phrasing really confused me when I first started learning about finance, so hopefully I can help explain it to you in a way that makes sense. So how come R sub t is required rate of return? That's because a lot of times when doing financial equations, it's all about comparing. You know a lot of different things, so you want to compare this investment versus that investment. Or I know if I go to a bank or use a mutual fund or an index or some sort of cash instrument or investment instrument that will get me money, that's pretty secure. I know what I can get with that. So if you're going to offer some other project or some other investment, a lot of times I expect a certain cash flow, or you can promise a certain cash flow with a certain amount of risk. So that's why that R sub t is a required rate of return. So this is that cash flow you expect to bring in, or really that cash flow that is really required based on your management or based on the financing. Now, discount rate, you can think about a few different ways. It is interest rate, but to help remember that, just think a dollar 100 years from now is worth much less today. Think about how much inflation changes the value of things. If you take that dollar 100 years from now and bring it all the way back to today, it's not going to be a dollar. I mean, think about even with a basic savings account at your local bank. People make fun of them for having horrible interest, and they do. But think about if you put in 50 cents. How much is that 50 cents going to be worth in 100 years? Maybe 80, 90 cents, maybe $1.20, but it gains value over time because the bank is giving you some interest for letting them have that money. So if you think about a dollar 100 years from now, that's not worth a dollar to you today because you can use a dollar today to go out and make more money. Even if you're not an entrepreneur, you can invest in things. You expect to earn a little bit of money on your money. Money gets discounted through time. You can also think about it as a discount. And I know that's kind of confusing because usually you buy something and if it's at a discount, the price of it is cheaper, which means you get to keep more of your money. So when you're talking about finance, if there's a discount rate involved, you're giving up money for a little while. But when you get it back, you have more of it. So if you're giving up money, a discount, something that incentivizes you to do that, would actually be giving you more money back later on. So just how discounting the price of something gives you more money, if you're discounting your own money, if you're letting someone borrow it or investing it, you expect to make some money on that. So the discount rate is going to be that percentage you get back. And again, the discount rate is based on time. Interest compounds. Interest helps things grow. So the net present value formula is saying all the money we expect to bring in from an investment or a project, we divide that by the time discount value of money. So whatever your interest rate is for that investment, that takes the money in the future and says, what is it worth to me today? $1,000 a year from now, what's the equivalent of that today? Knowing that I could take that money today and invest it in other things. So you take all your future cash flows, you bring them back to today's value, you discount them back using that discount rate, and that gets you part of the net present value. But then you have to subtract out whatever initial investments you made in that project. That gets you the net present value of something. Yeah, we could do this, but what is it worth to me today? What's the present value, the today's value of that? And it's net because we're taking all those future cash flows and subtracting out the cost to do them, the net present value. What is the future worth to me now? That was a very long-winded explanation of net present value, but it's important that the foundation is strong. Finance is all about, I have money and I only have so much time to invest it and I have options. I want to make as much money as I can in the shortest amount of time and pick the best option. So moving forward, we'll go a little bit faster. So here's an example of applying the NPV formula, applying the concept to kind of understand how it would work in the real world. Let's say you invest $10,000 in a high-end unboxing channel on YouTube. You know, one of those channels where people will open something new and review it. You have solid research that shows next year you'll get $500, the year after you'll get $2,000, and the third year you'll make $15,000. So, if you don't spend any of it, that would be $17,500. Alternatively, you know your local credit union that you're a member of is offering index funds that you can invest in that are historically proven to return 7.4% interest each year. Again, finance is so often about comparisons and where is the best spot to put your money. Well, which option do you go with? Let's calculate the net present value of your unboxing channel. So using the formula, we take the $500 cash flow in the first year, we discount it back to today's present value. We do the same with the $2,000 and the same with the $15,000. Now you'll notice, because of the way the formula works, the 1 plus your discount rate raised to the power of t periods, the farther in the future you go, the more you'll discount that back today. And that makes sense. Think about it. $1 a year from now is pretty close to $1 today. $1 10 years from now is not as good as $1 today. So you discount each of those cash flows back to present day value, then you subtract out your initial investment costs, and we are left with $2,717.73. So the net present value of your high-end unboxing channel is valued at $2,717.73. That is, using that money, that's how much profit you'll make. That's what it's worth to you today. Those are your incoming cash flows today. Whereas in 3 years, if you invest with the bank, your local credit union, you would have $12,388.33. A lot of this interest only compounded at the yearly level. So investing with the bank, you have $12,388. On the high-end unboxing YouTube channel, you end up with $17,500, like in the first bullet. So this NPV formula really helps you recognize that yes, investing in this project is worth about $2,700 more than just putting your money in the bank. It helps you choose from multiple options based on what the money is worth to you today. Alright, let's move on. You can talk a lot about net present value and discounting cash flows and compounding interest, but I think I got the main idea across. Time is money, and you can discount things back in time or forward into the future. Alright, so another pretty common financial concept is the break-even analysis, and I think this is one that more people are probably familiar with. Break-even analysis is a tool used to examine how much revenue on a product, project, or even a concept must be made to overcome all fixed costs and unit costs. It's very often described as a goal line, a target you're looking to hit. It can also be used as a risk tool. So hey, with this new product, how many do we need to sell to actually become profitable, to break even? Otherwise, we're at a loss. It involves margins. So I mentioned that fixed cost, but then I also mentioned that cost per unit. Well, whatever you're selling a unit for, once you subtract out that cost per unit, you're left with that contribution margin, that little bit left over for you. That is what you are applying towards the fixed cost. You need to make up for the fixed cost by selling a certain amount of units. Then, once you've paid off that fixed cost, every single unit you sell makes you that much more money. It can be really interesting to alter assumptions and play with the data to really use this break-even analysis to look at different scenarios. So similar to how NPV allowed you to evaluate the financial outcome of different options, break-even analysis lets you say, hey, if we raise the price on this thing we're selling, how many less of them do we need to sell to break even? Or if we can somehow decrease the cost involved, how many less do we need to sell to break even? Or with what we're selling currently, how much more profit will we make? Let's go into an example. You spend $500 to rent a booth at your local mall, and you want to sell homemade cookies. You have 200 cookies, and each one costs you 25 cents to make. How many of these cookies do you need to sell to break even? That is, to cover the cost of the cookies and to cover the cost of renting the booth at the mall. Well, the first question you should be asking is, what is the price? What are you selling the cookies for? This is one of the two things that you can typically vary in this equation, the other being quantity, of course. A lot of times fixed costs are very set in stone, and so are variable costs. So a lot of times your cost per unit is pretty much determined ahead of time, and your fixed costs, things like the building, startup fees, those are pretty set as well. Let's say we go with a cheap, high volume approach. You are going to sell your cookies for 75 cents each. That means each cookie you sell contributes toward that fixed cost by 50 cents. You don't get the full 75 cents because 25 cents of that is going towards paying off the ingredients in the cookie. So the eggs, the flour, the butter, the milk. But you have that 50-cent profit on each cookie that you have to use towards that fixed cost. If you made $100 profit on the cookies, but you spent $500 on the booth, you wouldn't feel like you're 100% profitable because you have to cover that fixed cost first. So with that in mind, take your $500 fixed cost, that is to rent the booth, and divide it by your 50-cent contribution margin you get on each cookie. You would have to sell 1,000 cookies in order for the cookies to pay for themselves and the booth you rented. This is the break-even point. So this is using a low price, high volume approach. Let's look at it if we sold them for a little more. Let's say we're going to sell them as high quality cookies and sell them for $1.50 each. In this case, how many would we have to sell to break even? Well, in this case, the contribution margin per cookie is $1.25. $1.50 selling price this time minus that 25-cent cost. That cost is fixed per cookie, but it's a variable cost because the more cookies you sell, the more ingredients you have to buy. In this case, taking our $500 fixed cost and dividing it by our $1.25 contribution margin tells us that we have to sell 400 cookies to break even. So essentially, if these are the same cookies, this approach seems better. You want to sell less cookies to break even, of course, but this is where things like demand curves and marketing come into play. If these cookies don't look that great, you might have some difficulty selling them at $1.50. If the demand for cookies isn't that high, your high volume approach of selling 1,000 might not work. Often too, these formulas aren't just used to break even, but to determine how many units of something need to be sold and or at what price it needs to be sold to meet a certain profit margin. So you can think about how easy that would be to calculate using the formula. Just add the profit you need to the fixed cost. So in this case, you wouldn't divide the $500 by the contribution margin. You would divide the 500 plus whatever profit you wanted to make. So say you wanted a $500 profit, then it would be $1,000 divided by the contribution margin. Those are a few basic formulas to help you understand some of the core ideas in finance. But beyond the formulas, you have to know the language to speak finance, especially as an engineer. Because if you're going to convince management you want to be able to use finance as much as possible. So let's talk about some good finance terms to know. Assets. One way that assets were described to me that I think really helps the idea stick. Assets are the expectation of a cash inflow. Whether it's a piece of equipment, a savings bond, or a building, an asset is something that pretty much guarantees a cash inflow in the near future. It's also known as a current asset. If you don't expect to get the money for a long time, that's a long-term asset. Now on the flip side, you have liability. This is the expectation of a cash outflow. This could be accounts payable, salaries payable, utilities payable. Often liabilities are expenses your company will incur, or even you yourself can have liabilities and assets. Your car, your home, those are great assets. The bills you have to pay every month, liabilities. Internal rate of return. This measures the profitability of an investment. It is the discount rate that makes NPV equal to 0. So think about our NPV equation earlier. We had the discount rate from the local credit union. That's what we were comparing against. If you were to take your $10,000 and just invest it at your local credit union and use the NPV equation, your net profit value would be 0 because you're not making any money on that investment. Now, in reality, you are, because that interest rate is going to be a lot better than inflation. But this internal rate of return is a tool used to compare different items in finance. This is similar to hurdle rate, the minimum rate a company expects to earn from investing in a project. This is the amount you want to overcome, the amount you want to hurdle over. It's usually a percent as well. So you are probably aware of interest rates being percentages, but there are all sorts of other percentages you can care about in finance that say all sorts of different things. Next we have CapEx. This is short for capital expenditure. These are funds used to acquire or upgrade physical assets, machinery, expensive tools, things like that. A lot of times as an engineer, if you want to buy a piece of equipment, you're going to have to justify it and then fill out the CapEx, the capital expenditure report. Then we have cash flow, the net amount of cash or cash equivalents, things that can turn into cash pretty quickly, savings bonds, things like that. Moving into and out of a business, so all the cash or equivalents coming in and going out. Cash flows are broken down into several categories: operating cash flows, investing cash flows, and financing cash flows. And if you think about it, you're really only going to use money for one of those three things. Either you use money in your day-to-day operations, you use money to invest in another company or venture, or you use money to finance, so to pay for things. Operating income. The income a company has after operating expenses are subtracted. This is also known as EBIT, earnings before interest and taxation. Sometimes you'll see a DA on the end of there, making it EBITDA. That's earning before interest, taxation, depreciation, and amortization. Operating income is near the top of your profit and loss statement, near the top of your income statement. Farther down, we have net income. So pretty much on your income statement, your profit and loss, you start with your general revenue at top, and then you work your way all the way down to net income in most cases. So net income is a company's total earnings after all items are removed. And you'll see a lot of those items on the income statement. Net income is also known as profit. A lot of times in business, people don't have a lot of time to look at a company's financial statements, so they'll look at a few key items. Net income is one of those few key items. It is usually a good measure of a company's financial health. Next, we have stakeholder, a person, group, or organization that has interest or concern in an organization. If you can relate things back to stakeholders, you're going to impress your management, because at the end of the day, it's the stakeholders that we care about. You have to make the relevant stakeholders happy. A stakeholder can be an employee or a customer, or a supplier, or a million other things. Notice how it's different from a shareholder. That's someone that actually financially owns part of the organization. And finally, we have working capital, which is a company's current assets minus their current liabilities, a measure of a company's short-term financial health. Think about it. It's everything you have on hand that you expect to make money off of in the short term, minus everything you're going to owe in the short term. If your liabilities, your current liabilities, are higher than your current assets, you're in trouble. Really though, as an engineer, especially an industrial engineer, when it comes to finance, you are probably going to be determining the value of things. Now, I've had previous videos touch on the topics of machine costs and human capital costs, so you can watch those videos for more in-depth explanations. These are some of the core areas in which engineering can cross over into the world of finance. So if you're going to get involved in finance, it's probably going to start in one of these areas. So just some general examples. You have a cost to upgrade or repair a machine. Compare that cost against the savings from the faster machining times or perhaps less defects created by the upgraded machine. Is there a cost to give employees more vacation, breaks, or time to perform a certain task? You can back up these costs with time studies showing that employees perform faster with more breaks, create products with less defects when given more vacation, or produce less scrap when given more time to perform a task. Those are just some examples. You're obviously going to have to do studies and compare the data and the actual financial information to make a case. But as long as the savings justify the costs, you can make a case to management. But you have to justify these with financial info, and that starts with good data. As an engineer or someone who's new to finance, it can be hard to think that time is money or you have to break even. It can be hard to think in margins and talk like finance people talk. But it is very valuable to learn the talk like this, especially if you need to make a case for an improvement or idea you've had. Thank you so much for watching this video. I know this was one of my longer ones, but hopefully you learned a little bit about finance. I think this is a topic that is very interesting and valuable, especially for people who aren't in the field of finance, so engineers can really benefit from it. If you liked it, please subscribe, tell your friends and family. Have a great day.